Okay, folks, Bill Campbell back here again. We're going to talk about derivatives, markets, and instruments. Another exciting reading. Here we go. What are derivatives? That's the first question. A derivative security derives its value from the price of another security. Generally, we call that the underlying, or an interest rate. So, for example, futures, options, forwards, swaps, these are all derivative securities because their value comes from the value of some other security. An option, for example, would be, let's say, an option to purchase a stock. The value of the option would depend on the value of the underlying stock. A futures contract could be on, let's say, a commodity. So the value of the futures contract would depend on the value of the underlying commodity, and so on. It could be an asset. The underlying could be an asset. The underlying could be an interest rate. Almost anything. There are a host of derivative securities. We're going to be concerned with 4 specific kinds of securities: futures, forwards, options, and swaps. Futures and some options are traded on organized exchanges. So these are standardized contracts. They're traded on exchanges. Frequently, the exchange or the clearinghouse will be a counterparty, so you don't have to worry about default by the counterparty. You're actually just sort of trading with the exchange. But when they're standardized, then there's a ready market for them and they can be traded on exchanges. Some derivatives, forward contracts, swaps, and some options are customized. They are tailored to the specific needs of the investor and therefore are not traded on exchanges. They carry more risk, but because they're customizable, they might be of potentially more value to the parties who are entering into them. All right, here's a tree that tells you something about how these are organized. Forward commitments and contingent claims. Under forward commitments, these are commitments to pay cash or deliver securities in the future. We have exchange-traded futures over there on the left. These are standardized contracts that are traded on exchanges. Then over on the right, we have the over-the-counter market. This is not an exchange. These are the customized instruments. These are the one-offs, the ones that don't have a ready market because they're for something very specific. Under that, we have forward contracts and swaps. I'll talk about all of these in detail in just a moment, so you'll see what all the details are. Contingent claims, these are options. A contingent claim does not obligate you to do something in the future, but it gives you the right to do something in the future. So it's contingent. You might exercise it, you might not. Depends on what happens. So it's contingent on whatever the circumstances are in the future. Sometimes you would exercise them, sometimes not. All right, the first of these, forward contracts. These are customized. These are special agreements written between 2 specific parties. They don't have an active secondary market principally because they are custom agreements. And the agreement may work very well for the 2 parties who have entered into it, but there may be nobody else in the world who has those specific needs and therefore would be interested in purchasing this contract. We have 2 sides on a forward contract. We have the long side and the short side. The long side agrees to buy whatever the underlying is. The short side agrees to sell whatever the underlying is. So, for example, you might have a forward contract on shares of stock for a particular company. The forward contract has a period of 90 days. So after 90 days, you as the long would agree to purchase that underlying stock at a specific price. The short would agree to sell that particular stock at a particular price. The asset is always specified. It could be a currency, it could be a stock, it could be an index, it could be a bond, it could be almost any other kind of an asset. It could be a commodity. It could be some other kind of a derivative. You could have a forward contract on an option or a forward contract on a swap. It has a specified date in the future when you perform. So you obligate yourself to buy if you're long, sell if you're short on a particular day. You set the price today. If the asset price goes above that price, then the long gains, because the long gets to buy it at a price that's cheaper than the market price. So let's give a simple example. Suppose that you had a forward contract on stock for ABC Company, and it's to purchase 1,000 shares of stock at $100 a share. And it's exercisable in 90 days. So in 90 days, the long has to buy 1,000 shares at $100 a share. The short has to sell 1,000 shares at $100 a share. 90 days from now, if the price of that stock is $120 a share, then what's the long going to do? They're going to buy it at 100 and turn around and sell it in the open market at 120. They're going to make $20 a share times 1,000 shares. They just made $20,000. The short is going to lose because the short has to sell the 1,000 shares at $100 a share, when in the open market they could have sold it at $120 a share. So the short loses $20,000, the long gains $20,000. But suppose when this forward contract expires that the market price is only $950 a share. Well, now the long loses and the short gains. The long has to buy the shares at $100 a share. I'm sorry, I said 950. Suppose the price is $95 a share. The long is obligated to buy at $100 a share, but the market price is only $95. So he's paying an extra $5 a share times 1,000 shares. He's losing $5,000 on the deal. Short is going to gain $5,000 because short is going to go out in the market, buy $1,000 for $95 a share, sell them with the forward contract at $100 a share, make $5 a share times 1,000 shares, $5,000. So you can see that both the long and the short have risk in these forward contracts. If the price moves up or moves down, depending on whether you're long or short, you could potentially lose money. A futures contract. A futures contract is just like a forward contract, but it is standardized and it trades on an exchange. So it would have a standard period of time and it would have a standard quantity, and the underlying would be a standardized asset, maybe a stock or a standardized commodity. It would, if it were a commodity, it would be standardized as to the quality, as to where it would be delivered, when it would be delivered, how it would be delivered, and so on. So it's all standard. So every futures contract, every 90-day futures contract on Chicago wheat is like every other 90-day futures contract on Chicago wheat. They're completely interchangeable, and there's a ready market because lots and lots of people like to invest in futures on wheat. So it's easy to get into these and it's easy to get out of these. When you enter into them, you enter into the enter into the futures contract with the exchange as your counterparty. So it's not between two individuals or between two corporations, it's between the investor and the exchange as the counterparty. So the counterparty, the exchange, does require that you make a deposit, a margin deposit, so that it guarantees that you will perform, that when the contract expires, if you're the loser on the contract, that they will get their money out of you. But in exchange for that, you have no counterparty risk. The exchange is not going to default. So if you end up gaining, you know that the exchange is going to make good on it. Whereas if you had a forward contract with an individual, you may come to the expiration of the contract, they owe you money and they don't pay you. Swaps. One way to look at swaps is that they are equivalent to a series of forward contracts. So a swap can have multiple payment periods. You might have a swap that has a payment 6 months from now, and a payment a year from now, and 18 months from now, and 2 years from now. So you can think of this as a series of forward contracts. One forward contract that expires in 6 months, one that expires in a year, one that expires in 18 months, one that expires in 2 years. And notice that we say forward contracts, not futures contracts. Swaps are customized. They are tailored to the specific needs of the two parties who enter into them. So just like forward contracts, they don't have a ready secondary market. They don't trade on an exchange. Once you enter into a swap, it may be very difficult to get out of that swap. By the way, another way of looking at a swap is that it is also equivalent to selling and purchasing bonds. Because what you're doing in a swap is you're trading cash flows. One party pays cash flows based on one set of criteria, the other party pays cash flows based on another set of criteria. It's as if one party sold a bond to the other party, the second party sold a different kind of a bond to the first party. The most common kind of swap is a simple interest rate swap. In a single currency, one party pays a fixed rate of interest, the other party pays a variable rate of interest. Usually, the variable rate of interest is tied to LIBOR, so it will be LIBOR or potentially LIBOR plus some spread. Payments can be based on interest rates, either a fixed rate or a floating rate. They can also be based on returns on a particular stock or on a portfolio of stocks or on an index or returns on commodities or almost any other way that you can imagine of coming up with payments. You can construct a swap that does that. Some swaps involve different currencies. So you might have like a US dollar for British pound currency swap, in which case, as I said, you can think of this as one party issues a bond denominated in dollars. They issue that to the other party. The second party issues a bond denominated in British pounds to the first party. And then the cash flows that you trade, think of those as the coupon payments plus the principal payment at the end. So different ways that you can think about swaps. These are customized contracts, so there is potentially some counterparty risk. Now we get to the purposes and criticisms of derivatives. Derivatives are frequently criticized as being a form of gambling, that people are gambling on the price. You know, what's the price of wheat going to be in the future? We'll gamble. If it's higher than this, we make a bunch of money. If it's lower than this, we lose a bunch of money. They are criticized as being extremely risky. Honestly, I think that most of this criticism is misplaced. Certainly people speculate using derivatives, but they speculate using other securities as well. So I don't think that's unique to derivatives. And although derivatives may themselves be risky, used properly in the context of an appropriate portfolio, they can actually reduce the risk of the portfolio. Go back to your portfolio management and remember what I was telling you back then about how you have to take a portfolio perspective, and you may, depending on the construction of the portfolio, you may be able to add a risky asset that in fact reduces the risk of the portfolio. There are a number of benefits of derivatives markets that are undeniable. They certainly provide price information. It's much less expensive, for example, to purchase stock options than it is to purchase a number of shares of the stock. And because the stock options expire in the future, the price information that you get from those options tells you about what the market thinks the future price of that stock will be. So you get future price information from the derivatives markets. Generally, the transaction costs are lower. It's much less expensive to purchase call options on a stock than to purchase the stock itself. You can enter into swap contracts and forward contracts with no money whatsoever, so very low cost to get in. Even futures contracts that are traded on an exchange, of course you have to put up a margin deposit, but the margin deposit isn't the full price of the contract, and the margin deposit doesn't have to be cash. You can deposit, for example, Treasury securities as your margin, and it's not that you're paying these, they still belong to you. You're just putting them in account as surety that you will perform what you say you're going to do on the contract. Finally, derivatives certainly allow for the transfer of risk. So if you have one party that because of the nature of their portfolio has a particular risk that may be difficult for them to bear, by using derivatives they can transfer that risk to another party who may be better able to bear that risk. So they're good risk management tools. The role of arbitrage. Arbitrage, well, you should by this point know what arbitrage is, but if you don't, I'll explain it simply. You have the same portfolio or the same security that has different prices in different markets. Now, when we say the same security, remember that the value of a security is the present value of its future cash flows. If you have two ostensibly different securities, but they have exactly the same cash flows and they have exactly the same risk, then for our purposes, they are the same security. So if you have like one portfolio has a certain set of cash flows in the future, another portfolio made up of different underlying securities, but it always has the same cash flows as the first, for our purposes, those two portfolios are identical. And if they have different prices, then you can, as an investor, earn a risk-free profit by buying the one that's less expensive and selling the one that's more expensive. You don't have any risk because you never really handle those assets. You buy them from party A and you sell them to party B. They don't even have to go through your hands. A can deliver them directly to B and you don't have anything to do with it. But if they sell at different prices, you can make a profit on that. We talked about this sort of thing in fixed income when we were talking about either stripping bonds into their individual cash flows and selling the strips, or buying the strips and reconstituting them, putting them together and selling the whole bond. The same thing. A package of strips is an identical security to the bond. It has exactly the same cash flows, but if the cumulative price of all the strips is different from the price of the whole bond, there's an arbitrage opportunity. What will happen when there's an arbitrage opportunity like this is that investors, arbitrageurs we call them, will start buying up the cheap security and they'll start selling the expensive, what I like to call the dear security. So they buy cheap and they sell dear. Well, of course, if you have a whole bunch of people buying the cheap security, you know what happens from your economics. As demand increases, the price goes up. So the price on the cheap security will start to rise. And of course, if they're selling the dear security, they're selling the expensive one, you know from your economics what happens when supply increases, the price goes down. So the price levels will initially start far apart, potentially, but as the cheap one gets bought more and more and the dear one gets sold more and more, the prices will move until they get back to the same level, and then the arbitrage opportunity is gone. In determining the price, the fair price for derivatives, we use this arbitrage principle all the time, that if we have identical payoffs, under all circumstances, we have to have identical prices. That's it for our first session on derivatives. Come on back for more. We'll talk about more in a little bit.